It looks like early Monday morning, Goldman Sachs is bringing out a new note to clients that they don't expect the Fed to raise rates at this March upcoming FOMC meeting. Now, this does have big implications this week considering AMC has their major vote, the biggest catalyst really we have seen with AMC in a very long time, on Tuesday, March 14th, the same day CPI comes out. Now, on top of all of this, you have seen the Fed essentially bailing out the deposits from Silicon Valley Bank as well as Signature Bank out of New York, essentially saying that everyone with money at these banks will get all of their money. And they're basically going to take the assets that have lost so much value that is causing this big problem to begin with, like bonds that have gotten destroyed in 2022, mortgage-backed securities. They're going to take these long-duration assets, treat them as if they have their full value because, hey, if the Fed trades $10 billion, call it cash, to a bank, they take on $10 billion of assets, whether it takes 2 years, 4 years, 5 years, or 10 years to get to maturity, the Fed will ultimately make that amount back, plus the interest that they would obviously pay on these bonds, right? Long story short, the Fed is bailing everyone out. Now that you are seeing Goldman Sachs coming out with this note, it is making the markets very, very bullish. Goldman Sachs is also saying that this will provide stability to the banking system, that they don't expect to see any more bank runs happening, while this has implications for AMC as well. Like we talked about in the last video yesterday, essentially these bank runs, this liquidity concern between banks, right? Even some of the large players, people are starting to look more carefully at these balance sheets of these banks. And the first thing that's going to happen is the riskiest loans are going to be recalled, the ones that they can actually recall, which would be, stock-based loans, right? Collateral-based loans with hedge funds, institutions. Those are going to be the first loans you can call back because it's not like a mortgage, right? It's not necessarily like a bond where you have to realize a loss. You just say, yep, we're taking all our loans back in. Now, that makes for an interesting dynamic in regards to a forced share recall, because this situation really put a lot of pressure on potentially seeing a forced share recall, and I don't think this really changes all too much. I think in the grand scope of things, banks are going to look a lot more closely at their balance sheet, and I still do think they're going to recall a lot of these risky loans that they have out to some of these hedge funds, and specifically around certain stocks like AMC that pose a substantial risk to the banks. Keep in mind, JP Morgan lost billions of dollars due to hedge funds losing their asses the first time around with the quote-unquote meme stocks. This is not like it's uncharted territory here. These banks can lose a lot of money very quickly if they are on the wrong side of these trades, or let these hedge funds be on the wrong side of these trades. Now that you guys have a little bit of backstory out of the way, hopefully that did sum a lot of things up. Let's get into exactly what Goldman Sachs is saying about this upcoming March meeting. So this article, it was posted early Monday, so like 12:14 a.m. to be honest with you guys. So like right as it went to Monday. So we're getting you guys this information literally as soon as possible. Hit the like button, subscribe to the channel if you have not already. Now, Goldman Sachs no longer expects the Fed to hike rates in March, cites stress on banking system. Key points, quote, in light of the stress in the banking system, we no longer expect the FOMC to deliver a rate hike at its next meeting on March 22nd, Goldman economist Jan Hatzius said in a Sunday note. This is really the part that has a lot of people excited, or at least in futures right now, up almost 2% across the board, S&P and the Nasdaq. It's this. The firm expects the latest measures to, quote, provide substantial liquidity to banks facing deposit outflows and boost confidence among depositors. So, not seeing that bank run at other banks, because when this was first announced, the Fed was going to bail out these banks. Essentially, can we call it that? It's literally a bailout, right? people were still concerned, like, is $25 billion enough? What if First Republic Bank starts to go under? Or what if Wells Fargo or Goldman Sachs itself gets into some problems? Is there going to be enough to stop it there? And the only reason way I should say, these problems would actually occur is if people kept pulling out their money, because they're like, yeah, 25 billion, that's only protecting these two banks. We're going to need a lot more than that, potentially. I don't want to take that risk. I'm going to pull my money out of said Goldman Sachs, Wells Fargo, so on and so forth. That's where you get a smaller problem turning into a very large problem. And just because the Fed said they were going to bail out these two banks doesn't mean the other ones were safe. Now it looks like you're getting more reassurance from Goldman Sachs, at least that they don't expect that to be a problem, more so stamping a seal of approval on the Fed's actions. Now, if we go ahead and take a look at what they do continue to say, Goldman Sachs economists said the package of relief measures announced Sunday stops short of similar moves made during the 2008 financial crisis. The Treasury designated SVB and Signature as systemic risk, while the Fed created a new bank term funding program to backstop institutions hit by market instability following the SVB failure. Quote, both of these steps are likely to increase confidence among depositors, though they stop short of an FDIC guarantee of uninsured accounts, as was implemented in 2008, they wrote. Given the actions announced today, we do not expect near-term actions in Congress to provide guarantees, the economist wrote, adding that they expect the latest measures to provide substantial liquidity to banks facing deposit outflows. And that's exactly it. If you have your money at these other banks, First Republic banks we just mentioned, if they have problems, you're not going to lose your money. I think Biden kind of made that the main message to Janet Yellen and Fed Jerome Powell, because they met the FDIC, head of the FDIC, I can't even remember his name, the head of the Treasury, right? Treasury Secretary Janet Yellen, Fed Jerome Powell, head of the Federal Reserve, as well as Biden, all met in a meeting to say, hey, what should we do about this problem? And either one of them or all of them came to the conclusion that we should protect all deposits. And that's kind of what you're seeing reiterated from Goldman Sachs, that we're not expecting to see this bank run as of right now, but it can still mean these banks are going to take precautionary steps to get some of these forced share recalls, to take out some of these loans that are hundreds of millions of dollars with these hedge funds, because those can very easily go the wrong way or implode, specifically on AMC coming down to March 14th. It's too risky. It's too risky for this market environment. You have not seen this much fear in the banking sector since 2008. I think forced share recalls is a very real argument to be had right now, even still that the Fed and the Treasury look to bail out SVB and Signature Bank, guys. So that is going to do it for this video. It's going to be very interesting how events transpire the rest of this week. If you guys want to stay up to date with all of that information, as soon as that information does break, I believe we are the first to report on this piece from Goldman Sachs, which is really adding a lot of momentum to this rally that we are currently seeing. Hit the like button and subscribe to the channel. Hit that notification bell to stay up to date with all of this information. Comment your comments, questions, or concerns down below in the comment section as well. Most importantly, enjoy the rest of your day, and I will see you in the next one.